Hello everyone, welcome to the video, and today I'm going to talk about the very interesting topic called the power of three. And of course, I'm going to talk about the law of liquidity. Now, this is the very interesting topic, and most of the people use this idea to trade. They use this as the strategy, and most of the ICT traders and most of the smart money trader, they use this concept to trade, and they can make a lot of money from this. So I'm gonna teach you guys how that power of three is and how to use it in your advantage. Now, the power of three explains the market cycle, the market cycle. And that market cycle is known as AMD. Now, AMD is stands for accumulation, manipulation, and distribution. So A stands for accumulation, M stands for manipulation, and D stands for distribution. And sometimes you can find this phase here. Let me use this. You can find this phase here called consolidation, and you can find this phase here called manipulation, or some people call it fake out and all that thing. But distribution here, um, some people call it expansion. So expansion, expansion. So here it's fake outs. Okay, fake outs. Now, I want to teach you something that will help you uh, make money in trading using this very simple concept called the power of three. Now, let's dig into this AMD thing. Now, the first one, which is the A now, the AMD, the first one, which is the accumulation, this here is where the setup begins, okay? Now, the characteristics of this accumulation is can be a little bit quiet, okay? Where you can find price creating a range, a consolidation, or a choppy sideways market, okay? I'm going to explain it in the chart. And here is where you find most of the little trader getting very bored, thinking that the market has to do nothing. But here's where the institution are preparing their guns, yeah? Preparing the guns. Now, the accumulation starts, and that's where the setup begins, okay? And the first two is the manipulation. This is where the fake outs begins, okay? Now here is where you find the market breaks that consolidation or the trading range and perform a thing called engineered liquidity. I'm going to explain that. I'm going to explain that. Now here's where price sweeps the key highs uh, and trigger the breakout where buyers or sellers are, uh, are losing their money there, okay? Thinking that we are going up, but the market goes down, thinking that they are going down, but the market goes up, okay? And the first three is the distribution. Now here is where the real move happens. So after the manipulation, the market runs into the true direction. Now here's where the money is made. Now let me explain a little bit here how this work. Let me explain a little bit here how this thing work. Now you may find the market creating maybe a consolidation like this, okay? Creating a support and resistance areas. Maybe it can be equal highs or equal lows like this. And then you find the market breaking that area, okay, creating a manipulation, a manipulation, creating a manipulation like this. Let me use red here, creating a manipulation, okay? And then the market, instead of continuing selling, the market goes up. The market goes up, creating a distribution. Now, all the sellers who were listing here, wanting to go and sell the market goes the different direction, creating a distribution to buyers. Now, to understand this concept, you need to understand the term liquidity, the law of liquidity. Now, let me explain the law of liquidity. Let me explain the law of liquidity. The law of liquidity defines that the market must create liquidity before it can deliver the price. Or many of us know that the other definition of liquidity, the law of liquidity, is the price creates more buyers in order to sell, or creates sellers in order to buy. How is this? How can you explain this concept in the chart? It is very simple. When the market wants to buy, it must create sellers first in order to buy. That's why you find the market creating highs and lows. The market can't go just up, because if the market was to go up, must be sellers involved to make sure that all the buyers get their orders. Okay. Now, in order the buyers to get their orders, the market must creates the sellers in order to buy. Okay, and then creates another sellers in order to buy, creates another sellers in order to buy. That's why we find that trend. Okay, same applies in a sell in a bearish market. The market creates more buyers in order to sell, creates again buyers in order to sell, creates again buyers in order to sell. That's why we find the trend, okay, the bearish trend. Now, that can also be in the time of AMD, where the market consolidates, and then if the market wants to sell, it cannot just go on and sell. No, the market will do what? The market will create more buyers first, create more buyers first, and then the market will sell. So this is how we find liquidity engineering. So whenever you see people teaching you liquidity engineering, know that that term liquidity engineering came from this idea of liquidity, the law of liquidity. Okay, the law of liquidity. That's where it came from. So what it means that in order for the market to sell big, the market needs to create a lot of buyers on the other side. Same applies if the market wants to buy big, they need to create a lot of sellers in order to go to the other side. Okay, so that is where we find the term engineer liquidity. Okay, the price is being engineered. Okay, so this is how this power of three works: accumulation, manipulation, and distribution. Okay, and the manipulation phase is where now the institution, the big boys who are trading, in the participants, the big participants in the market are manufacturing buyers or sellers in order to fill their big uh, opposite orders. Okay, so that you, in order to use this um, strategy well, you need to take a look on the manipulation phase, and there is where you can see how this actually works. Okay, yeah. So the steps is to identify the accumulation zone and look for manipulation and trade the distribution. Now I've sought out some of the examples here. Let me share with you. You can see here we had a, 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 a what? A consolidation phase, and the market closed above it, okay, creating a breakout. Now everybody will think that, okay, now we're about to go up. But look what it did. The market distributed to the downside. See? Distributed to the downside. Another example you can see here, we had a accumulation. The market breaks downside. Now everyone will target maybe a liquidity engineering or an order block over there or fair value gap. And look what it did. The market went up. Distribution. So accumulation, manipulation, and distribution. The power of three. The first phase, the second phase, and the third phase. See? You see, and we had another example here. You can see. Sometimes these accumulation phases is very, very difficult to understand. It's very, very difficult to understand. So you need to take a clean look. You see, the market faked out here, manipulated all these equal highs here, and then distributed below. You can see that. Another example, you can see here, the market breaks the equal lows here, and then distributed above. Accumulation, manipulation, and distribution. See that? Also here, you can see sometimes it can be just maybe double tops or double bottoms like this. You see, break from below and then distributed. See? Then here, another example. Swept all the liquidity upside and then distributed below. See? And sometimes you can see these examples. I mean, this strategy, it can work even in the highs and lows situation. For example, when you have a high and a low, the market breaks the high and then distributed below. Now, this is why we found the term liquidity engineering, where we find a market breaks above and then comes and creates a change of character. Now that is a liquidity engineering. So you can see even in this liquidity engineering respects the law of liquidity, where the market creates more buyers in order to sell or create more sellers in order to buy. It's very, very simple. Now, this is the very beautiful, it's a very beautiful concept, and it can work every day. It can work every day. It can work. Now, I've sought out some of the examples in the real chart today. So you can see here we had a trend Here we had this low and this high created, and then the market breaks downside. Now everybody thought now we're gonna have a sell, but you see the market did not sell, and it created a distribution. You see, so sometimes you cannot just find a consolidation. It can be in terms of a market structure where the market breaks below but creates a liquidity engineering, like I have told you, a liquidity engineering. See, that was the first example. Another example you can see in here. I had this entry today. I had this entry here where the market, we had a very small consolidation phase, accumulation phase here, and the market breaks above and then distributed. I entered after this retracement here. It was a very simple trade, and I catch all this move here. It was a very simple trade. It was a very simple trade. Another example which I took today. By the way, this is the 5 minutes chart. This is a 5 minutes chart. Another example which I took today, it was here. You can see here we had this, we had this sort of accumulation phase, and the market breaks up here and then distributed. I entered at this retracement here and catch this move right here. It was very, very simple. It was very, very simple. Now you can use this strategy to trade every day. Just the law of liquidity, which aligns with the power of 3, which is the AMD. So thank you very much, and I will see you on the next video. Thank you very much.